Hello everyone, welcome again to Hybrid Accounts, and today we are going to proceed with our standard called ICE 12 income taxes, like you see that one, ICE 12 income taxes, and this is second part of the standard, and today we are going to proceed from where we left. We had spoken of temporal differences, and now we have to go through an example explaining temporary differences in test understanding number one, just like you see it here. All right? Yes, okay. Now let's go on and read the question. It says, an entity dive provides the following information regarding its assets and liabilities is at 31st December 20x1, just like you see it, right? Okay, so you have the assets and you have the carrying amount, yeah, the tax paid and temporary difference. We said that the temporary difference is the difference between the carrying amount and the tax base of net assets. By net assets, we mean assets minus liabilities. But the question can come with why you only having assets or only having liabilities. So you can also do the same and deal with them the same way, right? Okay, what is the requirement now? Let's go to the requirement. Okay, we have assets and liabilities like you see. The requirement says complete the table with the carrying amount, tax base, and temporal difference for each of the assets and liabilities. All right. So that's what you are going to deal with. And when you get the temporal difference, it tells you that you have a deferred tax assets or deferred tax liability. If no temporal difference, then it means we do not have a deferred tax asset or deferred tax liability. All right. Let's start now. Now, as I told you, the carrying amount is just normal, like what we do in the financial books, right? But the tax base is kind of just trying to get the carrying amount for tax purpose, right? So, okay, let's go on. And actually, maybe before that, we should come back here, up here, and look for the explanations. We learned about how to get the tax base, right? Look here, the tax base of an asset is the amount, like you see, is the amount, right? Yes, the tax base is the amount that will be deductible for tax purpose against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the what? Of the asset. So if for that carrying amount we expect to recover, that's why we deduct the tax base from it, right? And in case those economic benefits are not taxable, what do you do now? The tax base of the asset is equal to its carrying what? Its carrying amount, right? Okay, then about the tax base of a liability, we said that it's a carrying amount less any amount that will be deductible for tax purpose in future periods. And in the case of revenue, let's say, which is received in advance, kind of a deferred income, right? We can say maybe the tax base of the liability is its carrying amount less any amount of revenue that will not be taxable in the future periods. So first of all, you need to get a glimpse of this so that it simplifies matters for you when you go further and try to make all attempts to get the solution and understand what is actually going on, right? Yes. Okay, now it's fine. Let's go on and solve. Let's go and look at it practically now. Let's leave those alone and let's go on a practical basis. All right. Let us delete this one. And now I think we are at the point of going on and proceed. Okay. This is test understanding number one now. Can go here, number one. I hope you can see this one, right? Test understanding number one. Yes, it's here. Yes, this is this one. I think here we are. Okay. Now let's start here. We say that a machine cost $100,000, right? Depreciation of $18,000 have been charged to date. So this is the accumulated depreciation. Tax allowances of 30,000 have been claimed. Now do you see how you do this? It's just simple, right? What is the carrying amount? The cost was 100,000, but accumulated depreciation for accounting purposes is 18. So 100,000 minus 18, you get 82,000, right? 82,000. All right. For tax base, you have the initial cost, which is here, and you have the tax allowance. Tax allowance is just like depreciation for accounting purpose, right? So 30,000 have already been claimed, and so we remain with 100,000 minus 30,000, which is 70 what? 70K. So you can see, all right, I have 70,000 or 70K, and so you could have the difference now, right? That's why when you go to the solution here, you would find this non-current asset having the worth of how much? Come and find that it has the worth of 82,000, while for tax base it's 70. Now, the temporary difference is the difference between these two, right? 82,000 minus 70, which gives you 12,000, right? Now, what does this mean? By normal logic, it is that if the net it shows that net assets are in our books are greater than those for tax authorities. What does it mean if our net assets are more? If we have more net assets than what the tax authorities know, it means that we have more resources, and so we should be charged more, right? Now that indicator of being charged more is reflected in this temporary difference. So if you take the tax rate, let's say 30% times 12,000, you would get 3,600, and this would be the deferred tax liability. So in case the net assets of the carrying amount are greater than that of the tax base, it means we have more resources, and so we should be charged more. And so it indicates the presence of deferred tax liability, right? Okay, let's go to the second part here. And we are told that interest. So yeah, we should have 12,000, like I have said, right? 12,000. Okay. And when we come here, we say interest receivable in the statement of financial position is 1,000. Maybe I've invested somewhere of the bonds, let's say, and so we have earned the income of 1,000, but we are yet to receive it, right? So we have it as interest receivable. Let's say maybe in the current assets, of course, let's say we just have that one, and then the interest will be taxed when received. You see the problem now. So in the accounting books, we didn't care. We know we use the accrual basis in the accounting books, right? Since you have earned something, you have the right to record the asset in the books, right? So you have 1,000 in the books, and that's no problem at all using accrual basis. But the interest will be taxed when received. You see, so the tax authority seems to be using the cash basis. So it cannot record any interest income until it has actually received it, right? And just by looking, you can see, let me try to display something here, that's fine. When going through the reality, let's try to do this. Let's presume that we are just doing the normal accounting entries. We should have done this way, right? By accrual basis, you should have said that, okay, I have earned the income because the income is of a credit nature. So I would have said credit interest income by 1,000, right? Since we use accrual basis, right? And so we should have also debited the asset. We should have said, okay, debit interest, what? Receivable. Interest receivable, just like this, right? Also 1,000. 1,000, right? Yes, this way. It's just simple as that way, right? That one is for accounting purpose. But now for tax purpose, we are told that the interest will be taxed when received. So until interest has been received, it means it is when you are eligible to record the interest in income, right? So for our case here, it is until we have the cash, until we debit the cash. So as long as you have not debited the cash, you are also not allowed to credit the what? The interest income. You see that? So that's why, since it will be taxed when received, it means you would have a zero asset. While for the accrual basis, we had the asset of 1,000. But when you are only taxed when you receive, it means if you haven't received, then you are not eligible to record an asset, right? So if that is the case, is why you'd come and find out that for tax purpose, we will have a zero tax base, right? Kind of a zero carrying amount, but we just pick it over tax base when it comes to for tax purpose, right? So that's why you'd say that, oh, so in that case, it should mean that I'm going to have a zero what? Tax base. 1,000 minus zero, you get 1,000, and you would say, okay, so for accounting purpose, I have more net assets and I should be charged more, and they should give a deferred tax liability, just like you come and see it here, right? Okay, Let's go now to the next part. And here we are, part 3, which says trade receivables here have a carrying amount of 10,000. All right, this is just normal for accrual basis. We don't care. The carrying amount is fine, 10,000. And the revenue has already been included in taxable profit. You see this? If the revenue has already been included in taxable profit, it means the double entry has been completed, right? And when we have sold something, you would record the income, let's say credit revenue as income, but also you would have to debit the trade receivable, the asset, right? So in this case, it shows that even the tax authorities just allow for that income, for that revenue, even if cash has not been received. So you can see the difference between this one and this one, right? For trade receivables, we say the tax authorities also allow to record the revenue and so the trade receivables even when the cash has not yet been received. So we should also have another 10,000 here, right? 10,000. So the difference is zero. So you do not have the deferred tax liability because nothing has been delayed. The tax authorities have acted in unison with the accounting practice, right? So that's what we have to get. And that's why when you come here, you would find the same thing. Tax carrying amount, just normal accrual basis, and the tax authorities allow for recognition even before receiving anything, right? Okay, let's go next now. All right, we are on inventory here. It says inventory has been written down by 5,500 to 4,500 in the financial statement. That's just good, right? Just an accrual base. Our main focus is on tax base because the other one is just a normal accounting practice. But now listen, the reduction is ignored for tax purpose until inventory is sold. So since we ignore that for tax purpose, it only goes to show that for tax purpose, we should not deduct the 500, right? If you do deduct the 500, it means that it's kind of an expense, an impairment. So it means that we debited impairment loss is an expense, and then we credited the inventory. So we affected the inventory, which is the asset, right? But for tax purpose, now we are told that we should not allow for that expense. It is not an allowable expense for tax purpose because we have been told until the inventory is what is sold. In case you are told that, okay, inventory has been sold, you should have said, okay, that's fine, we can do it. So we'd have to remain with our 5,000 here. And you see now would get the difference, but the difference now would be negative 500. You see now, 5 what? You see. That's why you have here 500, but what? But negative. Now, what does this mean? Look here now. The net assets now in the carrying amount, the net assets in the books is less than the net assets for tax purpose. So it seems that we have less resources in our books, and so we should be charged less. Being charged less means that now this one would give rise to deferred tax asset. So if you take this 500 times 30%, which is the tax rate presumably, we would say we have the deferred tax asset. So you can see, so at the beginning, deferred tax liability, nothing. And here we have the deferred tax asset, right? And now it's time to proceed. Let's proceed to the next steps. Here we are, liabilities. All right, so now we are at liabilities and we are done with assets, right? Okay, another example. Remember, this is the carrying amount column, while this one is the column for tax base, and the last one is the column for temporary difference, right? Current liabilities include accrued expenses of 1,000, right? This is just normal accrued expenses for accounting purpose. It has got no problem, like you see it here, right? Liability. And now let's go for tax purpose. This is deductible for tax purpose on a cash paid basis, right? So since nothing has been paid, then we cannot record the expenses. And since we cannot record the expenses, it means we cannot complete the double entry. So you don't record the expense, you also don't record the liability, right? So the liability should also not be recorded, and so you should have a liability of 0, right? Okay, now as you see for this illustration, they have made a nice illustration, right? For liabilities, I've decided to put a negative sign, but it's no big deal. Just what matters is what you do, right? And that's why I told you that we usually look at the concept of net assets. And net assets, what does it mean? Net assets means assets minus what? Like I need you to get the point where they've done that assets minus liabilities, right? For assets, we didn't have liabilities, so we said liability is equals to zero. That's why we didn't put any negative sign. But now, when we say it's assets minus liabilities, and you are purely dealing with liabilities, it means we have zero assets. So this one becomes zero, and that's why zero minus 1,000 gave us negative 1,000. But we can also do it conceptually, and you could obviously understand too, right? I told you, we speak of the resources that you have. If you have more resources in your accounting books, it means you have to be charged more and it would result to deferred tax liability, right? If you have less, it will result to deferred tax asset. All right. So when it comes here, you find that you have liabilities of 1,000, but for tax purpose, you have zero. So it means we have less resources because we are even liable to pay. So if you have less resources, this goes to show you that you would have a deferred tax asset, right? So you just take the difference there and you would have negative what? 1,000. And if you follow this approach, any negative sign here would mean the presence of deferred tax asset, while any positive sign would give the sign of deferred tax liability. So we'd have a deferred tax asset here, right? Okay, let's go to the final point. Accrued expenses have a carrying amount of 5,000. Of course, accrued expenses are liabilities. So if we follow the same norm, we'd put this as a negative sign, right? Yeah. And we are told the related expense has been deducted for tax purpose. So it has even been allowed for deferred tax purpose. So if the expense has been allowed, it means that the liability has also been allowed. If the liability has also been allowed, we say that the liability is also equal to 5,000, right? Just this way. So if you do this now, I would get the difference here if nil, right? We'd have a nil difference, and so would say we won't have any deferred tax asset or deferred tax liability. I hope you got that well, and let's proceed down here now. All right, now we're on deferred tax assets and deferred tax liabilities after getting the temporary differences, right? So how do we recognize them? We're going to see all that, right? Okay, just stay tuned. Wait, acha makelele. Wewe, wewe, hapa, jista kelele, umesikia? Ta kelele. Mmoja anamgoja bana. All right, so I still income taxes state that deferred tax, of course, you have learned that if you take the tax rate and you multiply by the temporary difference, you get the deferred tax. Then you are the one to know whether it's a deferred tax liability or deferred tax asset. Note that that temporary difference is not an expense. It is not an interest, it's not a tax expense, right? If a deferred tax liability or asset, it goes the statement of financial position. To get the tax expense, you need to get the difference between those two, the figures in successive years, right? You get my point. Let's say in the first year, you have the deferred tax liability is 100, but the previous year you had the deferred tax liability of how much? Of 80. So for this year, this will be the deferred tax liability in the statement of financial position. But to get the income tax expense, you take the difference. You say that previously it was 80, but now it is 100. An increment is 20. So income tax expense becomes 20. So no, you have not this. And I'm repeating it again, right? The temporal difference is usually an accumulation over several years, right? So you should be careful of that matter. All right, then, if that's fine, you can now proceed. So we say income tax expense. I mean, income taxes say that deferred tax should be provided for on all taxable temporal difference. Difference should be temporary, but of course they should be taxable. If not taxable, it's obvious. You can do that, right? Unless the deferred tax liability arises from the following. So any deferred tax liability that arises from the following, right, we should not included, right? That's why we say unless it arises from initial recognition of goodwill. Of course, for goodwill, you won't recognize that, right? On initial recognition, you base on IFRS 3 business combinations, and you get that goodwill. So upon initial recognition, you should record it, or the initial recognition of an asset or liability. No, so other than an asset of goodwill, it could be any other asset or liability in a transaction that is not a business combination. You see, goodwill is on a business combination IFRS 3, like I told you, but it could be on initial recognition of an asset or liability that is not a business combination. I don't know if you got this. Maybe you should go back to business combination. You know, when you go to business combination IFRS 3, IF what? IFRS 3, we usually get goodwill this way, right? We usually take the purchase consideration, for one amount of paid. Then maybe if you have the non-controlling interest, you can add it here, non-controlling interest. And then we get the net fair value of net assets. Now, on this fair value of net assets, even those which are usually not recognized, let's say, for example, under intangible assets, the intangible assets like the internally generated brand or what, they are always recognized here. So the only asset, the issues which we want to cover here, first of all, should be on initial recognition of what? Goodwill, which is obvious because goodwill is also obtained this way. This one plus this one minus this net assets. You get goodwill. So that's why you don't have to record it. But also, even these assets which will be added on fair value basis of net assets, they should also be considered for what? For deferred taxes, right? That's why you are told initial recognition of an asset or liability, right? You know, by net asset, I told you it's asset minus the liability. So getting the fair value at the acquisition, let's say with subsidiary, you could have additional assets and additional what? Liabilities. So we are not going to consider them, right? That's why you're told you should only take asset or liability in a transaction that is not a business combination, right? And at the time of transaction does not affect the accounting profit or taxable profit and does not create equal taxable and deductible temporary differences, right? My friend, this one is a very, very important point, and I think we should go through it again and again, right? Whenever you encounter complex matters, it should be very essential. I'm repeating again, this is said that deferred tax should be provided on all temporary tax differences. So whatever temporary tax difference you find, you should consider them unless this deferred tax liability arises. Consider umewabidi mlio kwenye initial recognition of goodwill unaacha. Initial recognition. On all taxable temporary difference unless the deferred tax liability arises from recognition. Kama kuja kwenye goodwill iache. Kama umekuja kwenye ambapo hizo combination. Hizi ndio unafanya. Goodwill hapana. Wenzake wale sawa. Yes, so just like you have seen here, right? It should be provided for all temporary difference which are taxable unless it arises from goodwill. So if it arises from initial recognition of goodwill, we say no. But if it arises from other assets other than goodwill in a business combination, right? The differences here, maybe the assets which arise here can be considered, and here can be considered, no problem, right? No, no problem. But in case maybe those assets or liabilities are not part of a business combination, right? And at that time of their transaction, they do not affect any accounting profit or taxable profit. If they have no effect, of course, they won't be there. So it won't matter. And does not create equal taxable and deductible temporary what? Temporary differences. And so, okay, deferred tax assets should be recognized on all deductible temporary differences. Should be the deferred tax assets. They should be recognized on all deductible temporary. You know, we can have deductible and the taxable. If something is taxable, it means you have a liability. If it's deductible, it means you have the asset, right? So that's why you say deferred tax assets should be recognized on all deductible. So just like that, right? So remember and understand the word deductible and the word taxable. If something is taxable, obviously it should be a liability. If it's deductible here, it should be an asset, right? You can claim it. So deferred tax assets should be recognized on all deductible temporary differences. Of course, I've even shown you an example in that question of getting the temporary differences, right? But we do that, and unless the exceptions above apply. Of course, if it follows the following approach, let's say if it arises from initial recognition or initial recognition of a goodwill, or maybe it is an asset or liability that occurs in a transaction, and at that date it does not affect accounting profit or taxable profit, which is obvious. If it does not affect, obviously it can have an impact, right? Yes. And maybe it does not create equal taxable or deductible temporary differences. So we don't have an impact that way. But also, unless there is insufficient taxable profits are expected to be available in the future against which the deductible temporary differences can be utilized, right? That is the situation. So when you do project in the future and you see that, oh, when you say you have a deferred tax asset, it means that the resources you have in a business do not seem to be less than those within the tax authorities, right? So he said that, okay, I have to claim something in the future, right? So if you do not have sufficient taxable profits, which you can generate in the future, it means you cannot match your resources to those of the tax authority. So if you see that it is not possible to match them, to increase them to such an extent, then you can say, oh, it's deferred tax asset. How do I call it an asset? Well, I'm not even going to get anything close to that figure. So that one won't be possible, right? Okay. So here, let's go with say recognition exemption and example. Let's go and look at an example of an exemption now, right? We have seen the procedures, but now we look at an example. On reporting date, Enchilada purchases a factory building for $1 million, right? And recognizes this as a property, plant, and equipment, okay, PPE. Uh, as per I-16, in Enchilada's jurisdiction, the building is not deductible for tax. You see that? So it's there, but it's not deductible for tax. You see the problem? So although the carrying amount would have increased by 1 million, but that is not deductible for tax. So there is no need to. Let's go on and you would see that. the tax rate is 20%. The carrying amount of the asset is $1 million, right? But the tax base is nil. Obviously, right? Because you have been told that in Enchiladas jurisdiction, the building is not deductible for tax. So if it's not deductible, it means all its depreciation are not deductible, and so we cannot recognize the asset, right? The worth of this asset. So that's why you say tax base is what? Tax base is nil because no tax deductions are permitted. As such, a taxable temporary difference of 1 million. There is a taxable temporary difference of $1 million arises, right? You see that it has arisen as $1 million here, right? But you see, despite the fact that the factory, the temporary difference is carrying amount minus tax base, right? Carrying amount of $1 million, tax base is nil, the difference is still 1 million, 1 million minus zero, right? So despite the fact that the factory building will generate taxable income of at least 1 million, otherwise an asset carrying amount is overstated, let's presume that it can generate what it has, right? We're not speaking of impairment here. We presume maybe this carrying amount can actually be regenerated and be recovered. And that's a tax charge of at least 0.2 million. It means 20% times 1 million of temporary difference. We get 0.2 million over its useful life. No deferred tax liability is recognized. You see this? So although we see that we have the carrying amount and we have the tax base, but still we cannot recognize the what? The deferred tax liability, although the difference seems to be there, right? Because you can see, we are told that the building is not deductible for tax, totally not deductible. You see that? So it is not even in that category. If it's not deductible, it means that is a permanent difference. So when it's not, you can say, okay, this one looks like that's why I say it should be a temporary, but actually, it should be it should be kind of deductible. But here it's not deductible, right? You cannot take that. So since it is not deductible, simply speaking, you can do anything from that point onwards, right? That's why you should always follow these principles here, right? Okay. So let's go here. How you have seen that already. The still is explaining this is because the temporary difference arises from the initial recognition of an item that has not affected the accounting profit. So I think that's I think we have got what we have been speaking of, right? So there is no need to go any further. Let's go on measurement here. The tax rate in force. Now, measurement of deferred tax liability, tax rates do change, right? According depending on how the government has decided. So how do you go on getting those deferred tax assets and liabilities? How do you go on getting those? The tax rate in force or expected to be in force when the asset is realized or the liability is settled should be applied to the temporary difference to calculate the deferred tax balance, right? So that is what should be done. You use the tax rate which is in force or expected to be in force by the time it is realized. Let's say that it is realized today, and you know the tax rate which is in force, you use it. Let's say today you have a tax rate of 20%, but you expect to realize it in 3 months' time, at which point the tax rate will be 30%. Then you apply 30%. So you just follow the principles, right? Yes. So as 12 specified that this rate must be based on legislation enacted or substantively enacted by the reporting date. So it could have been enacted already, or it could have substantially been what? Enacted. And deferred taxes and liabilities are not discounted to present, but this is what you should know. We do not apply the concept of time value of money to deferred tax assets and liabilities because deferred tax assets and liabilities go against the concept of framework and the future related, right? So since they're future related, you could have said, oh, to get their actual worth today, you have to discount them. But no, you do not apply time value of money on deferred tax assets and liabilities. I hope you got that. The entry to profit or loss and other comprehensive income in respect of this deferred is the difference to the net liability. Like I told you, if this year you have a deferred tax asset of 100 and the previous year it was 80, and these are the liabilities, then you say to get the income statement figure for this year, you just say, okay, previously I had 80 liability. Now I have 100. What is the increment? 20. So this increment of 20 is what should go to the income statement, right? In case maybe you had 80, liability, and now the liability is 60. What do you say? Again, we say that, okay, I had the liability of 80, but now the liability has fallen to 60. So it's kind of an income. So I should have 20, but this 20 now should go on to reduce the income tax expense for the year instead of adding it, right? Here you added, here it reduced it, right? So here we are told that it is important to note that if the item gives rise to deferred tax is dealt with in profit or loss, you have to follow. You know, the statement of profit or loss and the other comprehensive income, you have the part for profit or loss, but also you have the profit for other comprehensive what? Income, like the revaluation gain under I-16, right? So you should follow that principle, right? So if the item giving rise to it is dealt with in the profit or loss, the related tax, deferred tax should also be present in profit or what? Or loss. If it is in other comprehensive income, it should also be taken to other comprehensive what? Income, right? Okay, so that's what you should do. Let's go on presentation now. How do you present that? You know, presume maybe you have deferred tax assets and liabilities, but also you have current tax assets and liabilities. How do you present them? Now, deferred tax assets and liabilities are usually presented as non-current components in the statement of financial. So you know how to present them. And as 12 says, note that the deferred tax assets and liabilities can be offset as long as, presume you have the deferred tax asset and liabilities, so you have them on both cases. What are you going to do? But we are told that you can offset them. They can be offset as long as the entity has a legally enforceable right to set off the current tax assets and the current tax liability. So if the entity is allowed to offset current tax components, then they can also offset the deferred tax what? Components. But also, if the deferred tax assets and liabilities relate to a tax levied by the same tax authority, right? You know, we are just trying to get the point here, right? You know, when you do offset things and they come from the same tax authority, it means that nothing will have been distorted, right? As viewed by the what? By the stakeholders of the company, right? The major stakeholder like potential investors and lenders and the existing ones, right? So you can do that as long as the current components can be offset, but also as long as that deferred tax asset and liability come from the same what? Tax authority, right? Otherwise, you should explain each one separately. Okay, test understanding number 2, you are told you're using the information. In testing understanding 1, calculate the DIVE deferred tax balance is at 31st December 2021. The applicable tax rate is 30%. Oh, we're going to deal with the same question, the question that we did previously, right? But now we just need to get the deferred tax balance. So since the balance is, we are speaking of the statement of financial position now, right? We did that, but of course, let's just go back and redo it. Okay, test understanding number 2 here. We have been provided with the following figures. They just need a balance, right? So we had this asset. You know, we presume that we can offset the current asset, the current components, but also we can offset maybe the deferred asset and liabilities come from the same tax authority. And so instead of getting one after another, each one separately, or deferred tax assets alone and deferred tax liabilities alone, we just decide to combine them, right? So you see, you have 12,000 here. It is here. On interest receivable, it was 1,000. It is here, right? 1,000. On receivables, it was 0. We have the 0 here. Then on inventory, 500. It was deferred tax asset. It was negative. On accrual basis, also 1,000 negative again. We said negative is for deferred tax assets, right? Positive for deferred tax liabilities. You put it here, then you add and deduct, and you get this figure, right? After getting this figure now, you are provided with the tax rate. So you go on and multiply by the tax rate. So 30% times 11,500, and you get 3,450, right? You see now, this one, the answer was positive, so it is still a deferred tax liability, right? Deferred tax what? Liability. What about the entries now? Now, this I think this is the point you should also be very careful of because I specified something, right? I said that after getting this figure of 3450, this is the new balance for the deferred tax liability. It is a balance, right? The question told us to get the balance, and that is our real balance. So we should say the balance equals to 3450. That should not be the figure for the income statement. No, and never. You just have to understand why this has been the case, right? What we do, we look previously. Since in the previous period, you do not have any information on the deferred tax liabilities and the asset, then we say the balance was zero in the previous year. And on this year, we have 34, how much? 3450. Then this is what we do, right? This one is our new balance, right? This is our new what? Our new balance. So from zero deferred tax liability to 3450, so we say deferred tax liability has increased. This is the new balance. Without doing anything, if we are just told to get the balance, we would have said this is the balance and everything would have been over. But now, in case maybe we needed to make an adjustment in this financial statement, we would have said this way. Previously, we had the zero deferred tax liability, but now we have 3450. So it has increased by 3450 minus zero. So this is the increase. Deferred tax liability has increased by 3450, and that's why credit liability is of a credit nature. We credit deferred tax liability by this figure, but this is after deducting zero. So if previously we had 1,000, we would have deducted 1,000 to get 2450, right? And so since this is a difference, you also go on and say, okay, so our tax expense would also be the same figure, it's also the difference, and we get it here, right? So in case the question asked you that, okay, let's do this. Presume maybe here we had 1,000, the previous deferred tax liability, and currented this. In what would you have done in the current year? In the statement of financial position, but also in the statement of profit or loss. In the statement of financial position, we would have said, oh, our new balance is 3450, right? 34 what? 3450. But in the statement of profit or loss, we would have said that, okay, for profit or loss, we look at the increment. It has increased from 1,000 to 3450. So the difference is actually 24 what? 2450. And this is what I would have written. Okay? Yes. So that's all about this. And then I think we can proceed. Yes, let's proceed and look further and further. Okay, now let's go back here. Test understanding number 3. Let's read it and then we go to specific situations. Okay, test understanding number 3. Break is a company with a reporting a date of 30 April 2024, so it started on 1st May 2023. The company obtains a tax relief for research and development expenditure on a cash paid basis, you see. So the expenses are only recognized for tax purpose on cash paid basis. The recognition of material development assets during the year, in accordance with the I-38, created a significant taxable temporary difference as of 30 April 2024. Okay, the tax rate for companies is at the reporting period was 22%. You see, this was a tax rate for what? For companies. By the end of the reporting period was 22%. On 6th June 2024 now, beyond 30 April, right? The government passed legislation to lower the company tax rate to 20% from 1st January 20. You see now. Okay, what are we required to do? Explain what tax rate should have been used to calculate the deferred tax liability for inclusion. Okay, you see this point now. We said use that something that is in force or expected to be what? In force, right? Okay, at this point now, what would you have done? Have you seen the reporting date is 30 April? But about 1 month and a bit, 1 month and a week later, the government passes a legislation, right? And changes the tax rate from this to this, but you are told that it should be in force, or expected to be in force, right? by 20th January, by 1st January 20X4, X5. Now, which tax rate are you going to apply? So you go to the same principles and you come out with a solution. So you should be able to know well how to deal with the accounting treatments, right? So as we said, deferred tax liabilities and the assets should be measured using the tax rate expected to apply when the asset is realized. We said that, right? So this tax rate must have been enacted or substantively enacted by the end of the reporting what? Period. Now look, what was the end of the reporting period? 30 June, right? When was it said to be in force? It was 6 June. You see the problem now. So you see, the government enacted 20% tax rate after the period, right? It was after 30th April because it was 6th June, and therefore it should not be used when calculating the deferred tax liability for the year ended 30 April. For the year ended 30 April, the 22% is what is there, right? Yes, because it should be there for it to be applied. Now, what do you do now? We know that it is going to change. What are you going to do? Now, per IAS 10, which says events after reporting period, changes in tax rate after the end of the period. Probably. One of two. One of one of So dealing with that, we say that changes in tax rate after the end of the reporting day. You know, we have adjusting and unadjusting events, right, in S10, right? And so the changes in tax rate that affect the end, that affect after the end of the reporting period are usually unadjusting events, right? However, if the changes in the tax rate is deemed to be material, it could then be disclosed, right? That this change would happen at a certain time and an estimate of the financial impact that would have been, right? Yes, so it's just that way. All right, now let's go on and proceed with the specific situations regarding the standard. I think these are just scenarios that we can encounter in an exam, right? Let's deal with these specific situations. So let's say we first start with evaluations, how we deal with evaluations, and then we'd go on and complete this, right? Okay. So deferred tax should be recognized on a revaluation of property, just like when you do revalue the property, it would be immediately reflected in the book, but actually on realization, it won't matter directly as for the tax purpose, right? Until that asset is realized, right? Yes. So that's what you should do. We say deferred tax should be recognized on revaluation of PPE if there is no intention to sell the asset, right? But any tax due on the gain made on any sale of the asset can be deferred by being rolled over against the cost of a replacement asset. That one could be done, right? So we won't care. We will recognize it even if there is this intention, you don't care, right? You don't say that, okay, so I have no intention of selling this asset. So since I have no intention, it would never be recovered for tax purpose. So then I ignore it. No, it doesn't matter. It should be recognized, even if it won't matter. Even what? Even if there is no intention to sell, because for tax purpose, uh, we know that although we want to recognize the revaluation directly, but upon its realization, it could be recognized, right? We would get that value of the revalued amount because it is usually on fair value, right? But even if there is no intention to sell the asset, you should recognize it. But also, even if any tax due on the gain made on the sale of an asset can be deferred by being rolled over against the cost of a replacement asset, so that one won't matter. So revaluation gains are recorded in the other comprehensive income. That's what we do, right? We speak of revaluation gain as per I-16. That's what we are speaking of here, right? Because they are the ones, of course, these ones are usually taken to other comprehensive income. So even the tax effect should also do the same, right? And so any deferred tax arising on the revaluation must also be recorded in the other comprehensive what? Income, like for like. Profit or loss for profit or loss, other comprehensive income for other comprehensive income. Let's look at this example here. An entity Dodge owns property, plant, and equipment that cost $100,000 when purchased. All right, that is fine. It's here. And depreciation of 40,000 have been charged up to the reporting date of 31st March 2021. You should see that they are giving depreciation in an accumulated terms, right? Because we compare the net assets actually. Each item is a statement of financial position, so it's an accumulation. We don't do the income statements alone, right? So the entity has claimed that tax allowances on the asset are 50%. This is the depreciation for tax purpose, depreciation allowances for tax authorities, right? 50. On 31st March 2021, the asset is revalued to 90,000 and the tax rate is 30%. Explain the deferred tax implication of this situation. You see now, eh? Okay, let's presume that we are dealing with this without considering the revaluation. Without the revaluation, this is what we would have done, right? We would have taken our cost of 100 minus 40, and how much would we have? How much would we have? By doing this one, it's obvious that we would be having 60, right? 100,000 minus 40,000 would have 60,000 this way, right? And this one would be my what? My carrying amount, right? But we know the reality that there has been a change here, right? From 60,000, we have been told that the asset has been revalued to 90,000. So what is the revaluation gain? It means should be from 60 to 90. What is the difference? The difference is 30. So we can say that we have 60 plus 60,000 plus 30 what? 1,000. 30,000 purely comes from revaluation. 60 was just available for the income statement because it only involved the depreciation. So it's the income statement, right? So you can get the picture here. You can say, okay, let me do this. I could put it this way. This one is for statement of profit or loss. And the theta is for other comprehensive what? Comprehensive income, okay? Okay, now let's go to the tax base. What would be your tax base? We had 100,000, but tax allowances were only 50. So I would say I have 50 here because it's 100 minus 50 to get 50, right? 50,000. Okay, for other comprehensive income now here, we would put nothing because for tax purpose, we do not recognize this directly, right? So we still have a zero here, right? So you can get the difference. What would be the difference, the temporary difference? 60 minus 50, we have 10,000 here. And 30 minus how much? Minus zero, we have 30,000 again. You see, this is a temporary difference. So you can get the tax by multiplying by 30%. So 10,000 times 30%, how much are you going to get? 10,000 times 30% to get the tax now. How much do you get? It should be 3,000, right? And here, 30% times 30,000, it should be 9,000, right? Yes. So this is how we deal with these issues. And now, like you can see now here, I would have said, this is the deferred tax, and this is the deferred tax. We can have the total deferred tax. What is my total deferred tax by doing it this way? Maybe write it somewhere. Yeah. Let's do this. You can see it here, right? Okay, now this is what we would have done. Let's say we now have a new deferred tax liability of 3,000 plus 9,000, which gives us 12,000. That's my new deferred tax liability. But now we need to put in the entries. How do you put the double entries, right? I told you, we do not have any prior information about the deferred tax liabilities and assets, so we presume them to be zero. So you could have just said, okay, my deferred tax liability is going to increase by 12,000, which is 3 plus 9. It is going to increase by 12,000 because it is 3,000 plus 9,000 minus 0, the previous one, right? So I would say this is my deferred tax liability, right? How much? 12,000, all right? Now, this increase, this change in deferred tax liability should also be reflected in the income statement. Now, as per the income statement now would say, 3,000 of it would have come, would have arisen in the statement of profit or loss. So in the statement of profit or loss, I would put the tax as per the statement of profit or loss is how much? The 3,000 and 3,000. And we would have also put here the tax expense in other comprehensive income is how much? Is 9,000, right? And this way would have been done. Okay, let's go to the solution there and see what they also want to speak of this. Clear this and then let's go down. Okay, this is the dodge we have here, right? So you can see all this one, what they're speaking, but at the end, this is what we're going to do. Deferred tax liability, you have 12,000 here, which is a difference, right? Between 12,000 and a zero. And here, profit or loss figure, you have this one. In the other comprehensive income, you also have this one, right? Yes. We like to use this approach. You can be using this one, right? You know, other comprehensive income, mostly when they happen, you will be told. So you can just do them all, and what remains can just come to profit or loss as a balancing figure. Although on your case, it was just zero, so it was very clearly visible, right? Okay. Then we can proceed with the next question, next scenario. Share option schemes, IFRS 2. We have dealt with IFRS 2, right? Okay. So you see, there are standards which you have to understand first before going through this one. Share option scheme. Share option schemes, they are very common in IFRS 2, share-based payment, paying actually if it's either employees or any service providers or providers of goods based on shares, right? And share options are common for equity settled share-based payment, right? Yes. So in accordance with IFRS 2 share-based payment, a remuneration expense is recognized in profit or loss through the vesting what? Through the vesting what? The vesting period. Remember then, we are recording the expense there in the income statement. By recording the expense, we reduce your profit. By reducing our profit, we reduce your net assets. You see, we reduce your what? Our net assets, right? So if you reduce the net assets, you could find that the net assets of a company are less than those net assets of what? For tax purpose, right? That's why we say tax relief is not normally granted until the share options are what? Exercised for tax purpose. So while we will be recording this in the books, we will be waiting for tax purpose until the share options have been exercised, right? And so the amount of tax relief granted is based on the intrinsic. This is the point now. The amount of tax relief that is granted should be based on the intrinsic value of the options, which mean the difference between the market price of the shares and the exercise price of the what? Of the option. That's what we call the intrinsic value in this situation, right? At the time of exercising, let's say the share is worth $10, right? The share is worth 10 what? $10. But you are told that, okay, don't worry, although it's worth $10, you are told that you can be at liberty and just purchase at, let's say, 8. This is the price, but you entered the option contract to purchase at 8. So the difference here is 2, right? So that 2 we call the intrinsic what? Intrinsic value. And that's why we say here that the tax relief is granted is based on the intrinsic value, that difference, right? This delayed tax relief means that the equity settled share-based payment, I told you for share-based payment, you have equity settled and the cash settled, right? But here we are speaking of share options. The share options would rely on what? Equity settled share-based payment schemes. So they would give rise to a deferred tax asset. I told you it's easy to know whether it's a deferred tax asset or liability. It's just very simple, right? We just look at the net assets of the business and the tax authority. For the business, for the accounting terms, we just say that we record an expense each year, right? We record an expense each year as regards to what? The remuneration, right? So by recording an expense, we mean that we lower the profit. By lowering the profit, we lower the net assets. While for the tax purpose, it won't be done until the date of exercise. You see that point now? So you find out that the net assets of the business are less than that of the tax authority. So you say, oh, so we have less net assets. If we have less net assets, then we have to be provided with something good because we have less. If you have to be provided with something good, would it be an asset or a liability? Obviously an asset, right? For compensation. So that's why we say you should have a deferred tax asset. Right? Yes. So this is what you'll be doing. Just know that the tax relief should be based on the difference, right? So the following pro forma can be used to calculate the deferred tax asset arising on equity settled share-based payment. The pro forma but is just an average thing, a normal thing, so it shouldn't be that much of a big deal, right? Okay, but let's just go through it. So this is what we are told to do. Let's remove this one. You can take the carrying amount, as you can see here. Carrying amount of what? Of a share-based payment, which is normal. We usually do this. Carrying amount of a share-based payment, less the tax base of a share-based what? Payment. And you get the difference, right? If our difference is multiplied by the tax rate, we get the deferred tax asset, right? Same formula. Same what? Formula. So I hope you have also got that. Let's go down here. Let's go down here and get a picture of this reflection. You had a reflection here, right? On the tax base of share-based payment. So the tax base, how do you get it? It is the expected future tax relief based on intrinsic what? Intrinsic value. You have explained that already, that it is based on intrinsic value of the options that are accrued by the reporting what? By the reporting date, right? So just based on that, to get the tax base, and we are told where the amount of the estimated future tax deduction exceed the accumulated remuneration expense. what happened then when in case of this situation? The amount of estimated future tax deduction exceed the accumulated remuneration expense. It means this indicates that the tax deduction relates to partly remuneration expense and partly to equity, right? If you have gone through IFRS 2, you know that when you deal with equity settled share-based payment, we usually credit something in equity and then we debit something in an expense, right? So in case there is a difference, then it means part of it is on an expense and part of it is related to what? To equity. So it won't matter. The balancing figure will just be taken to the other side. Therefore, the deferred tax must be recognized partly in profit or loss and partly in what? In equity. This one shouldn't be a big deal. The balancing figure will just go the other way around, so you won't have to worry about this at all. Okay, let's go and look at an example now. This is an example, and we are told here the entities, which is called Splash, established a share option scheme for its 4 directors. This scheme commenced on 1st July 2008. Okay, this is fine. Each director will be entitled to 25 share options on condition that the directors remain with the Splash for 4 years, right? From the date the scheme was introduced. So the principle is to stay with the entity for 4 years. Information regarding the share options is provided below. We have the fair value of the option at grant date, which we usually use to value our instruments, right? To value our options. Exercise price of an option, we have it. The fair value of the shares at 30 June 2009 was how much? $17 per share. We have it again. Okay. What next? What next? Okay. We are told here that a tax deduction is only given for the share options when the options are exercised. This is obvious, right? It is usually done this way. And the allowable deduction will be based on the intrinsic value of the option. This is also obvious. They have just stated this to simplify matters for us, right? Assume the tax rate of 30%. Okay, what are we required to do? Calculate and explain the amount to be included in the financial statement of Splash for the year ended 30 June 2009, including explanation and calculation of any deferred tax implication. Okay, so our year end 30 June 2009. That's the point to start with, right? 30 June 2009. Where does the scheme start? Oh, the scheme starts here 1st July 2008. So 1 year later, it should be 30 June 2009. So we just need to account for deferred tax just 1 year into the start of our scheme, right? Yes, just 1 year into the start of our scheme, and we're going to do that. All right, so first of all, I think we should follow the normal principles of IFRS 2 to get the worth of what? To get the worth of what? To get the worth of these instruments, how to account for equity. We should know what equity is and what an expense has been, right? How do you usually value that? This is what we usually do, right? We usually do it this way. We look at the number of options and how many options are there. We have 25,000 options, right? These options are per each employee or per what? You have been told the scheme, each director will be entitled to 25 share options. So it's 25 options per director. We need to know the worth of these options, right? By the end of the first year. So 25,000 options per director. How many directors are there? We have 4 directors. So if you do multiply by the 4 directors, you will get total number of options available, right? Now, to get the worth of the options, we are told that fair value of option at the grant date equals to $10. So for equity settled, we usually use the fair value at the grant date, right? So if you do multiply that, we would get the worth of our options. So our options would actually be worth this value, right? But now, this is the total value, right? Now, by taking this total value, remember that we have like 4 years, right? You have to time apportion it, and so you have to multiply it by 1/4 to get the worth. What are you going to get? You can see here 4 and 4 would cancel out. So would remain with 25 there, 1,000 times 10, which would be like 250,000, right? Yes. So this is what we would get, and this one would be the equity. Equity. All right. So since this would be the equity, we can make the double entry. The double entry should be this way. I would say credit equity, or we just say other components of equity. Other components of what? Of equity, which is 250,000 here, right? And then we come here and debit the expense, which they call the remuneration what? Expense in the income statement, which is usually taken this way. You take this equity and then you minus the previous equity, but we have no previous equity here. So it should be 250 minus 0, which is the same to what? 250. So we should have 250 again here. 250 this way, 1, 2, 3, right? Okay, so until this point, we have valued our options and you have them at 250, right? Okay, then we can proceed from here. We have dealt with the IFRS 2 issue now. Then let's go to our standard now. We need to compare to get the tax base 2 and compare them, right? And they also told that you need to get that intrinsic value. And for the intrinsic value, look now, okay? You have been told that you can purchase each share option for $5, but what is the weight of the option of the shares? Fair value of the shares at 30 June 2020 was 17. For something worth 17, you can purchase at 5, so you can generate a value of 12. 17 minus what? Minus 5, right? Okay, let's go. Let's just delete this and we go further to cancel this out. Okay, here we are. Let's get down. Here we are on Splash, right? So first of all, we'll come here on Splash, right? You have seen it and you have got the picture of how we usually do that, right? You can see it here. The expense for the scheme in the year ended to 30 June 2009 should be this way. 4 times 25 times $10 grant date times 1/4. You have seen that. But now you go on acting on this standard now, no longer on your IFRS what? IFRS 2. For tax purpose now, tax relief is allowed based on the intrinsic value of the options at the date they are exercised. So this is what we are going to do, right? And like I told you, the shares now have a market value of 17, but you can purchase them for 5. So I told you generate an intrinsic value of $12. So the options therefore have an intrinsic value of how much? Of 12, right? That if you purchase, you gain 12. That's what we mean by an intrinsic value. So how do we get the deferred tax asset? As usual, we compare the carrying amount against the tax base, right? So what would we have on the carrying amount of share-based payment? Of course, we won't have any carrying amount of the share-based what? Share-based payment, right? Yes. So we'd have a nil value here. And now, how do we go on getting the tax base? We said that we value the tax base on the intrinsic value. So it would be like this one. You can come up here. We said 4. You see that 4 times 25 is usual, no problem. Now, instead of using the fair value at grant date, which was 10, we use the intrinsic value, which was 12. So it should be 17 minus 5, which is how much? Which was 12, right? Yes, after getting that 12 now, you multiply by 1/4, just like here, and you get your what? Your tax base. So you say that, okay, this is good now. I have my tax base of the share-based payment at 300. And then if you deduct here, you get how much? You get 300,000, right? So here we have a figure, and here we have nothing. You see this? Yes. So after getting this, you just take away 30% of the figure. You get everything here. 30% of 300,000, you have 90,000, and this should be your deferred tax what? Your deferred tax asset. But now, how do you recognize it now? We said that it could be divided into an expense, but also into equity as a balancing figure. So this is how we are going to recognize this now, right? We know that we have a deferred tax asset of 90, but to record it for this year, you do not just put there 90. You can see just been written 90, but you look at the previous year, nothing has been shown, so it seems previous it was 0. So from 0 to 90, we say that the deferred tax asset has increased by 90. So from 0 to 90, we get 90. That's why we debit deferred tax by 90. You get my point? I hope you got that. Then when we do come to the issue of profit or loss, we are going to do it this way, right? For profit or loss, it's easy. Remember, we already computed the remuneration expense, which was equal to equity, and we go to 250, right? We got 250 here. This we have 250, right? So just multiply it by 30%, and how much are you going to get? This one multiplied by 30%, you're going to get 75. So this one should be on the credit side, right? 75. The remaining balance, if you see something remaining, it has to go to equity. And so the balance, you could just say the balancing figure. The balancing figure should go to equity, right? 90 minus 75, you get 15, and this one should go to equity. So this is what you should have actually done for this case. I hope that too is fine. I don't know, maybe if you have any queries or what. If that's not the case, then we can proceed. Okay? And say if the deferred tax asset is to be recognized, it must be recorded as recoverable. Of course, you have the deferred tax asset, it means you are going to recover the taxes later. So you should be able to recover them, right? So it should obviously be recoverable. If you cannot recover it, then it's nonsense to record it, right? Okay. Then let's proceed with the other applications. You know, right now we're just on applications, but the standard is actually done. We have the leases here, leases, IFRS 16 now, right? Leases and temporary differences. We can also have the temporary differences as regards to leases. And we say here, IFRS 16 leases requires lessees to recognize the right of use asset as you know, as long as the lease liability for all leases. It doesn't matter the lease is an operating lease or a finance lease, it just has to be done, right? Unless the lease is short-term or minimum value. Of course, if it is short-term or minimum value, then there is no need of applying IFRS 16, right? So we are told some jurisdictions grant tax relief on the leased asset, whereas others grant it on the lease liability. Now it depends on the jurisdiction someone is working on, right? Temporary differences may be created depending on the tax laws in the jurisdiction the entity operates in. Now, at the date the lease is entered into, the accounting profit and taxable profit are unaffected. Of course, it's just the date entered into, so nothing has been, no transactions have taken place, right? However, if equal taxable and deductible temporary differences are created, then deferred tax should be recognized, right? In case we have something like that, we have equal taxable and deductible temporary what? Differences, right? Okay, now let's just look at this. You know, if you look at examples, it gets better and better for you, right? So no temporary difference is example. Let's look at an example where there is no temporary difference. An entity enters into a lease agreement and the present value of the payments to be made is 4 million. Present value of lease payments, we mean. So we usually record the following. We debit it as a lease liability, present value, its present value, and then record it as the right of use asset. This is just the normal principle of IFRS 16. That's why they're just copying it, right? So you see here, the right of use asset and lease liability both have a carrying amount of 4 million. You see, so if this is the case, it means that if the tax jurisdiction grants tax relief in respect of the leased asset, what is going to happen? It could base on leased asset or leased what? Liability. So it really depends what will be considered, right? So here, in case maybe it bases on the leased asset, right? You know, you have the asset is going to be depreciated, right? In case you do that, then you'd have to be provided with the tax relief, right? So in case it does that, we say the right of use asset has a tax base of 4 million. Of course, this is what we do. Even for the normal asset, when you purchase the asset, if the carrying amount is 4 million, in the books at the very beginning, the tax base is also the same, but maybe the depreciation rates may just differ, but before it should be the 4 million again, right? So this is what would happen. But also the lease liability has a tax base of 4 million, which is obviously in there, right? The carrying amount, any amount, let's say any amount that will be deductible for tax purposes in the future, right? In your case, nothing has been specified that it will be deductible for tax purposes in the what? In the future. This is just a normal definition of the tax base of a liability, this one, right? So you see, you have 4 million and here we have 4 million. So we say no temporary differences arise on initial recognition of the what? Of the transaction. And so no deferred tax should be accounted for, right? Because the difference is zero now. Simply speaking, net assets difference equals to 0. So deferred tax asset will be recognized subsequently if temporary difference what? Do arise, right? So in case temporary differences arise, that's what we're going to do. That's why you can come and get the point here, right? It was well written somewhere here, right? Okay. Temporary difference is an example. Okay, let's look at the temporary difference now. Now it's the same case. You see, you have the right of use asset 4 and 4 here. Tax jurisdiction now has given tax relief on lease liability and not on lease the asset. Look at this now. The right of use asset has a tax base of nil, right? Because now remember, the tax relief has been provided on lease liabilities. So if it is provided on lease liabilities, it means lease assets have no what? They have nothing to be provided with the tax relief, right? And if that is the case, then we mean the tax base is 0 because no depreciation is allowed for tax purpose. So we say the right of use asset has a value of 0. You see, if it has a value of 0, what would we mean now? If it has a value of 0, it means carrying amount is 4 and this one is nil. So you have nothing. You can just compare it to this previous one, right? You can see what happened in the previous one. This one is 4, but here the carrying amount was also 4. You see, there was no difference. For liability, we had 4 here, and here we had 4 again. No difference again, right? But when we do come here now, you see, we have 4 here, but here we have nil. And for liability, we say the lease liability has a tax base of nil. And what should we mean by this nil? We say that the carrying amount less any amount that will be deductible for tax purpose in the future period. So whatever is deductible, if they tell you that there is an allowance on a liability, then you come and deduct it from your liability to get the tax base, right? So this is the normal definition of the tax base of a liability. You take your liability and then you deduct what is allowable. So you go on and deduct here. Previously we said 0 because the allowance, actually the deduction was provided on an asset, but now it is on a liability. So you say that we have 0, right? So what do we see here? We say equal taxable and deductible temporary differences arose. Equal taxable and deductible temporary difference what? Arose because the right of use asset and the lease liability are both initially carried at what? At 4 million. As such, the deferred tax should be recognized. You see our point here now. I hope now you have seen this. You can clearly see the difference between this part here and the above part. Here you have the right to, you have 4 and here you have nil, right? So you see that the asset the carrying amount of the asset exceeded the carrying amount of what? It exceeds the tax base of an asset, which was 4, so it had to be taxed at 4, right? And for the liabilities, you see, the carrying amount of the liability was 4, but for tax purpose was what? Was nil, right? So it is the reverse one, right? Now we have this liability, which we can put. We say that we can be putting the negative sign here. You see, so it is still negative, right? So this one is kind of not taxable and it is deductible because we have to be provided with the allowance. So we be taxed 4 and then deduction is 4. It has the same figure. That's why you say in case we have equal taxable and deductible temporary difference, and then we should record the what? A deferred tax. Well, if you go up here and do compare, let's compare it with the last time. I hope you get this very well. The right of use asset here had a figure of 4 on the carrying amount, while on the tax base, it had what? It had what here? It had 4, right? You see 4 for what? For 4. So here you see that there's no difference. The difference was 0, so nothing was taxable, right? But when you go to the liability, we had 4 here initially. And here, how much do we have? The lease liability, we had 4 too. 4 and 4 is also nil. But you see, now it's nothing. You say that, okay, they are almost going to be the same, but we have nil. There is nothing to be done, right? That's why you see no temporary difference arose on recognition of the transaction, right? And so deferred tax should not be what? Recognized. While if you do come here, we found that we are going to recognize that. So I hope that is fine and everything can go well now. Well, hii ni nne. Unaangalia. All right, now let's go to the question here, test your understanding. Here we are, test your understanding number 6. We are told B10 has a reporting date of 31st December 20x1. Okay, this is fine. On the reporting date, it enters into a lease agreement to hire a machine. The present value of the lease payments to be made is $10 million. And in B10's tax jurisdiction, tax relief on leases is given in respect of lease liability, right? The lease liability usually gives that, but the lease asset doesn't give that. Okay, as payments are made, the tax rate is 30%. Required to discuss the deferred tax implications of the above in the year ended 31st December 20x1. All right, we are told discuss the deferred tax implications of the above in the year ended 31st December 20x1. Okay, on the reporting date, so it is on the reporting date that it entered into a lease agreement, right? Okay, so let's go to this is test your understanding number 6. You go on and put your entries there and everything then would go on, right? Okay, so initially when we start recognizing, we are told that we had the present value of lease payments at $10 million, right? So that what would we have done? We would have debited the right of use asset at $10 million and they credited the lease liability at what? At $10 million, that's fine. What matters now is our tax base. What would have done on what? On a tax base, right? Yes. So this is what would have done. Would have said that we have an asset here, but also we have the what? The liability. Now, if you start with the carrying, we get the carrying amount, but also get the tax base. We get the carrying amount on the liability, but also get the what? The tax base. Okay. As for the asset, we know that the carrying amount is $10 million. And for the liability, we also know that the carrying amount is how much? It's $10 million. Let's go for the tax base now, the asset and liability. The question has specifically told us that 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 relief is provided on a tax liability, right? So since it is provided on a tax liability, it means that on the liability side, to get the tax base of a liability is usually taken as its carrying amount minus something that is tax deductible. And since it is available on a tax on a liability, it should be 10 minus 10, which would give us nil, right? So we should have a tax base of nil as regards to the what? To the liability, right? And now let's go to the tax base of an asset. What would be the tax base of an asset now? The tax base of an asset, actually an asset has not been mentioned, right? It has not been mentioned anywhere. So since it has not been mentioned anywhere, it means that the tax base of an asset is zero, right? So we just put it as zero, right? So you should learn that the tax base of a liability is its carrying amount minus any amount that is deductible. But the tax base of an asset is obvious. You just look whenever the deduction is the relief is provided there or not. If not provided, then we put zero. We do not take carrying amount minus something. We don't do that, right? Okay, so you do that. If you do that, we get the temporary difference here is 10 minus 0, which is 10. And so we have to be charged. This is the taxable temporary difference, right? But for the liability, we usually put this as negative, right? We also have the difference here. It should be negative 10. It's 10 again, and this one is deductible since it's negative, right? So you see that they are equal, right? They are equal. That's why, and you're told that the tax relief granted relates to the lease liability. That's why we did it that way. And so, and we have the tax base of the liability is nil. We have explained that. The transaction is not a business combination. We are told if it's a business combination, then we have to be careful. And it affects neither the accounting profit nor taxable profit, like you can see here, right? There are those rules which are provided that we have got this, and this, the transaction is not a business combination and it affects neither accounting profit nor taxable profit. However, equal amounts of deductible and taxable temporary differences are created. Equal amounts. You see, this is taxable is 10, deductible is 10, right? So a deferred tax asset would be recognized. So how much? You just take 30%, which is the tax rate, times this difference of 10, and you would have 3, right? Assuming that sufficient future profits are expected against which the differences can be utilized. So you're going to get that figure now to put your double entries. It's simple. You have a deferred tax asset of 10. Previously we had 0. So you say, okay, the asset has increased by 3, has increased by 3 this way. And so we should also have the deferred tax liability by the same figure, which is how much? Which is 3. All right, that I think that is fine because you can see you have the assets and liabilities. This one gives you the assets and this one gives you the liabilities, right? So at this case, we won't have anything to go by in the income statement. All right, let's proceed. Next one, additional lease payments. Okay, I think the question just tries to go deeper into IFRS 16. Okay, this is usually the first entry, right? But sometimes it may happen that maybe end lease payments there can be lease payments made in advance. Usually when you are given this present value, they give the present value of future payments, right? They don't include the current payment, which might have already been paid. So in case maybe you paid something in advance, which is no longer a liability, and so it wasn't included in computing the present value of these payments, which is a lease liability, there could be a separate entry. If you have done it for a 16, I think it could be there for you could see, you could understand what I'm speaking about, right? So that amount, you debit right of use asset here and you credit cash, right? Because as an entity you have paid. Of course, in case maybe you had the present value of all payments, including the present one, then it would mean that amount would already be here in the lease liability. So you would have had to reverse. You would have had now to debit lease liability so as to reduce it and then credit cash. It would be debit lease liability and credit cash in case that present value, that amount paid in advance was in lease liabilities, right? Which is not doesn't make sense in the reality, but it depends on the nature of the question. So usually we'll be doing this, right? I can see they have decided to dwell on this, on lease, even on these matters. Okay, let's proceed. So temporary differences arising from the first accounting entry are assessed for deferred tax recognition, right? Ngoma ndefu mwanangu, bado kabisa. Unajua bado kuna remittance, kuna mambo. All right, so temporal differences arising from the first accounting entry are assessed for deferred tax recognition separately from the temporal differences arising from the second accounting entry. So try to distinguish those two, right? Okay. So whenever you encounter something like that in an exam, you have to differentiate them. Okay, test understanding number 7. Let's go on this. We are told, Justin has a reporting date of 31st December 2021. On the reporting date, it enters into a lease agreement to hire a machine. On 31st December 2021, Justin paid initial direct costs of $0.2 million. You see, initial direct cost of this figure and made an advanced lease payment of $1 million. So there are two things paid before actually starting out the lease, right? The present value of the lease payment is still to be made is 8 million. Still to be made. Still to be made means the present value of future lease payments. So it doesn't include this advanced lease payment, right? Because it is still to be what? Still to be made, right? In Justin's tax jurisdiction, tax relief is given when lease payments and costs are incurred in cash, right? You see? When they incurred in cash. It has been ascertained that the tax relief granted in relation to the lease liability, it has been said that the tax relief granted is in relation to the lease what? Liability, and the tax rate is 20%. Okay, what are you going to do now? Discuss the deferred tax implications of the above in the year ended 31st December 20x1. Okay, so what are you going to do with that? We have the 8, the present value of future lease payment, advanced payment, and the initial direct costs. Okay, so we are going to deal with them separately as we said, right? Okay, this is Justin. We have here Justin. Let me expand it a bit. Okay, so this is what we're going to do. First of all, we'll start with that 8, right? Just like we did before for 8, right? So as for 8, we say that we'd have the asset here at 8. Remember, we had the carrying amount and the tax base, just like before. And for the liability, we would have the what? The carrying amount and the what? The tax base. Ignoring those initial costs which we paid, we will only remain with 8, right? So we say the carrying amount of an asset of A was 8, but the liability was also 8, right? We said you debit right of use asset at 8, and you credit lease liability at 8 again. So these are what I've written here, right? But the question explicitly tells us that uh, the grant of tax relief is provided on lease liabilities. So for lease assets, we would say you have nil, while for lease liability, to get the tax base, you take the carrying amount, which is 8, you minus that 8, which is what is deductible, right? So 8 minus 8 would have 0, right? So okay, we said for liabilities, we should put negative sign here. So it's just like the previous question, right? You'd have negative 8, which would be allowable. And for the assets here, you'd have positive 8, which would be taxable. You see that one? So if you just take this one and multiply by 20%, you would get 8 times 20% should be 1.6, right? 1 point what? 1.6. And so you should have a deferred tax asset of 1.6 and deferred tax liability of 1.6, just for the previous question. But now we have additional costs being incurred. Let's go and look this now. So the present value of this lease payment is 8, like I told you, and it's fine. And recognize it, like I showed you aside here. The tax relief granted relates to the lease liability rather than the right of use what? Asset. For right of use asset, we wouldn't have recorded anything, right? Because we said for lease liability, in case the taxable amount is equal to the deductible amount, then we say we create a what? The deferred tax. Okay. So does this mean that the tax base of the lease liability is nil, like you see it here, but the carrying amount of the asset is 8. This creates a deductible temporary difference of 8, which is here. We have shown that already. For the asset, the tax base of the right of use asset is nil because no future tax relief is granted, right? You got no any relief. So, that one is given if you have a relief. But the carrying amount is still 8. So we said 8 minus 0 and we got 8 there. We already have that one, right? Taxable temporary difference of 8 arises and it is taxable, and not the initial cost and payments are dealt with separately below. Like I told you, we are dealing with that separately. So until now, we'll be already having the deferred tax asset at 1.6 and deferred tax liability at 1.6. Now we are going to deal with those initial costs and payments of rent, right? This transaction is not a business combination and it affects neither the accounting profit, no taxable profit, and however, it has created equal amounts of deductible and taxable temporary differences, and also we are going to get exactly the same figure. Mhm. Ndio anazungumza na mimi akisikia mnafundisha watu All right, so like I told you, see here, you're told that we would have a deferred tax of 1.6 million, assuming that sufficient future profits are expected against which the difference can be utilized. So a deferred tax liability would also arise and be recognized at this figure here, right? So the entries would be, they be deferred tax asset 1.6 and deferred tax liability 1.1.6. Now, we go to the second point. This is the main reason for doing that example, right? The above one we did from the previous example. We have initial direct costs, but also the first release payments. You see, initial direct costs are how much? $0.2 million, while the advanced release payments are $1 million. They are paid immediately, right? And so they are entries, right? We credited cash and we paid them outright. Okay, so that's why I say the initial direct cost and the advance payments are included in the right of use asset. So they are together, you can combine them here, right? You have 1 and 0.2. So if you add them together, uh, you would have 1.2 million, right? So together, these two payments would give this carrying amount. What about the tax base? How do you get the tax base now? Are they claimable? Are they deductible? Is the relief provided in them? Nothing is specified on that, right? Yes. Since nothing specified on them, because you see, they are on right of use asset. Right of use what? Row or right of use asset. But remember that the relief is provided on lease liability. That's what the question said, right? The release is provided on what? In relation to what? To lease liabilities. So the tax base should be nil. So you have 1.2 million, but the tax base is nil. So the difference, you see that the carrying amount is higher than that of the tax authority by 1.2. So we have more resources than the tax authority, and so it should be charged. So we have a taxable temporary difference of 1.2 million, which we can actually multiply by the tax rate to arrive at the deferred tax liability. Because since this is taxable, it means it would result in the deferred tax liability. So 1.2 times 20%, you would get 0.24 million. And so we would say, okay, ignoring this, we say that we do not have the previous history on deferred tax liability. So I would say we would move from 0 to 0.24, which would mean deferred tax liabilities have increased by 0.24. That's how you credit it. And the balancing figure on the debit side would be the tax expense this way, right? So you'd have two sets of double entries to make when you do encounter something like this, all right? Okay, now let's go on and on. We have a multiple applications here, so just have to be patient, okay? Yes, it's just about application now, so you don't really need to worry about this. Okay, unused tax losses. We are speaking of unused tax what? It may happen that the business is operating. Maybe in some years it makes a loss, some years it makes a profit. So there could be some decisions made for that, right? So we are told where an entity has unused tax losses, right? You have got the losses, but maybe you are allowed to offset them in the future, but you are yet to use them. What do you do? So I-12 allows a deferred tax asset to be recognized. So you can say that, okay, I have an asset, recognize the deferred tax asset, but only to a given failing, right? Only to the extent that it is probable that the future taxable profit will be available against which the unused tax losses can be utilized. What do I mean? Let's say that so far you have the losses, the tax losses of $30 million, right? But then you say, okay, yes, I have to claim this. If I got the right to claim this, then I need to record the deferred tax asset. By what can I do it? Let's say that you are able to claim even seven to get 70 in the future. It means you can claim all of this 30, right? So you can create the deferred tax for all 30. But let's say maybe you only expect to have 20 in the future, then you cannot recover all 30. You can only go on to the extent of recovering a maximum of what? A maximum of 20. So it's just that way. So I still advise is that the deferred tax asset should only be recognized after considering the following. All these are just a way of actually enhancing this probability, actually be sufficient, be content that it is really probable. The word probable just means you can be certain of very probable, right? Okay, so what should we follow? to be kind of comfortable. So we should consider whether an entity has sufficient taxable temporary differences against which unused tax losses can be offset. This number one has already been stated. Whether it is probable the entity will make taxable profits before tax losses expire. You see this? Yes. You can say that, okay, I can have 70. You say, okay, this is fine. My last tax losses are 30. I can have 70. After what span? Maybe you can have 70 in 3 years' time, right? Well, maybe these tax losses maybe after a year they will no longer matter, right? So we only have to look at the cutoff period too. That's what we mean. But also whether the cause of the tax losses can be identified and whether it is likely to recur. It means that in case it is likely to recur, it means it could happen again, right? And the tax loss could end up increasing and increasing. And if it end up increasing, you would still be in problems now, right? Otherwise, the existence of unused tax losses is a strong evidence that future taxable profits may not be what? Available. Yes. If you have unused tax losses first year, losses second year, you keep making losses, then how could you say that I could have sufficient profits in the future, right? So maybe if you say that, okay, don't worry, COVID-19 happened and hampered my business a lot. That's why I have tax losses. So since we have recovered, I'm sure, actually, I'm certain that I'm going to recover all these tax losses and everything's going to be fine, right? But if it's just tax losses and no normal course of the business and nothing has changed, then you would say, okay, how am I going to do that? It's very wrong to record the deferred tax asset because you lack grounds to do that. All right. And then lastly, we're told whether the tax planning opportunities are available, right? Tax planning opportunities, of course. Tax planning is not like tax avoidance, right? Tax is not like tax evasion. If you do tax planning, it's like you just make a proper follow-up, right? You don't go against the tax laws, you don't go against the authorities, but actually just make sure that everything would go well. Okay. Let's look at the example here. Now you're told test understanding 8, red. At 31st December 2021, red has tax adjusted losses of 4 million, which arose from a one-off restructuring exercise. You see, just arose from a one-off restructuring exercise. It's not like it's going to repeat and repeat and repeat, right? The cause that is it was just a one-off restructuring, and so my business was greatly affected negatively, and so I'm going to recover this. Under tax law, these losses may be carried forward to relieve taxable profits in the future, right? So Red has produced forecasts that predict total future taxable profits over the next 3 years of 2.5 million over the next 3 years. However, the accountant of Red is not able to reliably forecast profits beyond that date. You can see this, right? So the tax losses are only 4 million, but 3 years next we can have this one. So you see, 2.5 is less than 4 million. So you can be should we have the deferred tax on all of 4 million or just 2.5? Because you can't be sure beyond that date on whether you can generate more profit from which you can use to offset these losses, right? You see now? Okay, so what are we required to do here? Okay, explanations go on and say the tax rate for profits earned during the year ended 31st December 2021 is 30%. However, the government passed legislation during the reporting period that lowered the tax rate to 28% from 1st January 2022. Explain the deferred tax implications of the above. Okay, what are you going to do? So you also have these two tax rates, and you have to apply the principles you applied before, but just this one start from 1st January 20 what? 22, and here you on 31st December 10x1, right? So you obviously know that the tax rate of 28 is going to be used there. All right. Let's now go on and look at what we have to do. Test understanding number 8. Test understanding number 8 is here. Test understanding 8, and we are told that, look now, a deferred tax asset can be recognized if it is deemed probable that the future taxable profits will be available against which the unused losses can be utilized. This makes sense, and this is a point. But look now, the tax losses have arisen from an exceptional event. Being exceptional, it means it won't be happening and happening and happening, so that's fine. It's suggesting that the entity will return to profitability. And since it returned to profitability, it means that it satisfied the above principle here, right? It is deemed probable that future profits will be available, right? Forecasts produced by the accountant confirm this. But now this is the problem. Red can only forecast the profits of 2.5 million, right? While the problem was actually on 4 million. So you can say that, oh, so you can't deal with all 4 million. Let's just take 2.5 because there is no way. That's why we say this limits the deferred tax assets that can be recognized due to that thing now, right? So we say deferred tax will be calculated using the tax rate that is expected to be in force when the temporary difference reverses based on the rates enacted by the reporting date. And this one is obviously 28% because, you know, the information was given 31st December 2021, but this enactment was given from 1st January the next year, right? So the deferred tax should be based on 28%. You multiply 28% by 2.5 million, you get this figure here, right? And then you have to recognize this deferred tax asset, right? So you'd have to go on the debit side and say, you'd have the deferred tax asset. Now, you first look previously, like I told you. If you already recorded the deferred tax asset previously, then you have to look for the difference, right? Of course, instead of nothing, then it was zero. So from 0 to 700, you get 700. So you debit 700K. And then on the credit side, then it would have to be, you go and credit the tax expense. Tax what? Tax expense in the income statement of 700. If you credit by 700, it means it would reduce the tax expense, right? It would act like a credit, right? Yes, so you just do that and everything gets better and better. In case in the future, maybe you get more profits, or you forecast more profit, then you can add more deferred tax assets. Yes, and that would be fine. Okay, today we have to go on and on and on these matters, right? Okay, maybe let's make it the other part here. You see, it has been too long and too long. So